Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly video with our friends at Strategas. Today, we are lucky enough to be joined by managing director and technical strategist Todd Sohn. Todd, how are you doing today?
Hey Ross, I'm great. Always nice to speak with you.
Good to talk to you as well. A lot going on, but market at near all-time highs, so a good time to be chatting. I want to start actually with the big news of this month or so has been the Fed rate cut, 50 basis points, a jumbo size cut for what they usually do. And something we've talked to you about before is all this money that has gone into cash and money markets over the last couple of years, record high after record high. And I'm curious, if you've done any work on what starts to happen to that cash once the Fed begins cutting, and two, where you think it might go, or if there's a level that sparks kind of an outflow, and is that going to equities or bonds or gold or just whatever you're thinking about that topic, because I think it's really interesting for 2025.
Yeah, this is one of my favorite topics of the moment, really of the cycle necessarily, right? The 0% interest rate environment to 5.5% before this cut. Saw over $1 trillion go to retail money market funds, and then another 5 to 600 billion to institutional money market funds. So flows to that product have absolutely surged. Now, this is going to be a fascinating psychological test going forward. You're going to start to see money market yields dip below 5% with the 50 basis cut. And historically, most investors are still going to be comfortable with that, right? You're still going to get your 4.5%, 4%. But it's really the 3% level where I believe that you'll start to see money market inflows either slow down or perhaps go to outflows, because that's when competitive yields start to come in play. And on an after-tax basis, it may not make necessarily a lot of sense to sit in cash. In the 90s, when the Fed cut to 3%, money market flows slowed down. And then while these are different examples, given where equities were in 2000, 2007, also when you hit that level, you started to see inflows stall out and eventually turn to outflows. And so I'd look for 3%. We're not quite there yet. And as for your second question, where does it go? I think for equities, it's hard to earmark a lot of that cash for stocks, given the entirely different risk spectrums they're on. Unless you start to see some sort of a bear market for stocks, then people would like it. But I think the more likely scenario is fixed income ETFs. There's over 700 fixed income ETFs now. The space is booming. And you can get a similar yield and duration or credit risk if you needed to in that product spectrum. There's a lot more fixed income ETFs at this cutting cycle than have been historically. And so investors can transition out of those cash-like products and into the ETF wrapper, get the deal, again, the yield or duration that they want. We think that's going to be a major trend going forward.
Well, and speaking of yield, when the Fed cuts rates, I'm interested to get your take here, what the market is saying. So on one hand, you could say, well, yield sensitive sectors should outperform things like home builders or really economically linked sectors, because we've got this soft landing, the Fed is cutting rates, it should spur those more cyclical sectors. On the other hand, your defensive sectors that are yield proxies with nice dividend yields, your staples, your utilities, have also been acting okay, but not exactly what you would potentially want to own in a risk on environment. What are you seeing in terms of sector outperformance or relationships? What do you expect to work into 2025 based on this kind of falling yield macro backdrop?
Yeah, and I look at staples as really this great arbiter of, okay, are we heading into some sort of major economically weak patch? And they just don't suggest that yet. They continue to hit new relative lows. Credit spreads are still pretty tight, behaving well. It's when I start to see spreads widen out and staples outperform that I get much more worried. I'd also look at discretionary versus staples. Consumer discretionary is still outperforming staples on the whole. And I think if you are going to be in a falling yield backdrop, but you don't want to get defensive because that's going to be the wrong leadership, then you can look at stuff like real estate or even financials. The REITs have been in a bear market for the better part of 2.5 to 3 years, and you're finally starting to see a lot of that space really improve. And so if you're looking for something away from AI or technology exposures, you can look at real estate and financials, and those are portions of the S&P 500 where it's a lot easier to get overweight than, say, buying more tech and owning over 30% of that in your portfolio. So we like the idea of financials and REITs. Again, if you're going to see further economic weakness, you can pay attention to what staples and credit spreads do. But right now, they're just not suggesting anything is there, which is great for the environment heading into next year.
Yeah, we'll take it. Let's end here. What is gold sitting around all-time highs telling you about the macro backdrop?
Oh gosh, it's gold has been a curious one. I think you could make a list of variables, right? It could be a weaker dollar, it could be lower rates, it could be geopolitical risk, right? At the end of the day, I view gold as a sleeve in your portfolio, right? If you wanted something besides equities, besides bonds, you can buy that commodity. And from my own perspective, I do find it strange that you really haven't seen much interest in gold ETFs this year. Yeah, flows have started to pick up a little bit, but it's one of the odd cases where you have an asset that's performing well in an uptrend at new all-time highs, and yet money's not really chasing it. And I think that's because equities have been so resilient, and you are getting yield on fixed income for the first time in quite some time. And so, we can argue what the message from gold is, but at the end of the day, it is a helpful portfolio diversifier, a geopolitical diversifier to some extent. And so if you can allocate some cash there, we think that makes sense. And we're yet to see much of a pickup from the flows backdrop. I think it's helpful for sentiment overall.
Todd, thank you so much for the time today. Always good to talk to you.
You too, Ross. Thanks a lot.